International Business Machines, ticker IBM, turned $67.54 billion of revenue into a net margin of 16%. Very few companies keep that much of what they earn. Here is how the information technology services company does it. That margin didn't stop this stock from posting its worst single day in over a century, and the reason traces straight back to one word: debt. By the end of this video, you'll know exactly how much IBM owes against what it owns, and whether that leverage is powering its comeback or putting it at risk. Here's the number that matters. Total debt sits at $64.6 billion against just $32.6 billion in equity. That's a debt-to-equity ratio of nearly 1.9. For every dollar shareholders have in the company, IBM owes almost $2 to creditors. Net debt alone is $47.6 billion, dwarfing the $13.6 billion sitting in cash. And the current ratio is 0.79, meaning short-term liabilities actually outweigh short-term assets. Here's the twist: that same debt load is part of why return on equity is sitting at an eye-popping 34.5%. Borrowed money is doing a lot of the heavy lifting behind IBM's returns. Despite all that leverage, the stock isn't priced like a runaway risk. Its price-to-earnings ratio of 20.9 sits below Microsoft's 27, Cisco's 33, and Oracle's 25, though it's still richer than Accenture and Alphabet. Volatility tells the real story of that crash. This stock has swung nearly 80% annualized over the past 30 days and has fallen as much as 37.5% from its peak over the last year. So is this heavy debt load a hidden risk or the engine behind IBM's rebound? Subscribe if you want more of these numbers-first breakdowns, drop the next ticker you want dissected, and remember, this is analysis, not a recommendation, so dig into the filings yourself before you decide.